You've got outperforms on Bank of America, on Citi, on Goldman, on JP Morgan, BB&T, SunTrust. Now, I know there's a different conversation between the big banks and the regionals, but I got a lot of people throwing shade at a lot of sort of your universe. Well, you're positive going in?
Don't leave the barbecue when it comes to banks. I mean, we have the steak on the grill. The main course is coming. It's going to be decent when it comes to credit quality, cost control, capital return. The dessert might be delayed. Okay, so we'll give a little bit. Capital markets, it's not coming through in a big way. Loan growth, it's not coming through in a big way. The capital return story is not this quarter, but don't be like a bunch of whiny kids at a picnic. Where's our ice cream? Where's our apple pie? Where's our s'mores? The dessert.
I don't know, the steak's been on the grill for so long, the propane's run out. That's the problem with this.
Hold on, Mike. Let me call your attention to one fact. Josh is not here, so we don't need the food analogies. But
he's at Shake Shack.
Well, he left out one thing. Who's the cook?
Right. But
who's the cook?
But the issue is that you've got the relatively narrow purview of banks, right? So with you, it's which bank's going to outperform the other banks in your universe. You can go to holds, you can go to sells and all of them, but we've got the option of looking at other companies that are financial services or fintech.
I know.
To put our money in.
But let's stay on these big banks, because there's a decidedly different opinion between Mayo's calls and where most of you, including Kevin O'Leary, think these stocks are going to go.
Well, first of all, these factors that are driving earnings for the quarter are not just cyclical factors, they are structural factors. So credit quality should stay better for longer. Cost control in the industry should be the best it's ever been in 5 years. And capital return, by the way, the biggest buyer in the market is coming to the market in the next couple weeks. That's the banks themselves. They've just been approved for the biggest buyback in history. It's delayed until they report earnings, and then they're in the market buying the stock. So let the stocks do whatever they're going to do the next couple of days. Then the banks come in there, and you'll see that in the EPS growth over the next year. That's really powerful. And one other point, Steve Weiss said, the narrow purview of the banks. Well, banks lend to all the other industries. And there's one statistic that stands out more than any other, and that's loan delinquencies, which is a forward predictor. Loan delinquencies right now are about the lowest level they've been for the last 3 decades. Credit quality is good, and it's going to stay good, and you should see better results in the second half of the year. And that's where my questions will be. What do you see in the outlook? Loan growth, period-end loans are actually up. Capital markets could pick up if you resolve some of these trade issues. And the cap return story, that's in the cards.
So Mike, when you look at it, there has to be a catalyzer, because what's worked in markets is continuing to work, whether it's tech, whether it's growth over value, whether it's U.S. over international. What has worked continues to work. And what is the pivot point? What is the catalyzer? Because we happen to be overweight banks, and we're overweight financials broadly. What is the catalyzer to make this shift happen where we finally start to see some of this outperformance?
Well, we'll concede there's been a headwind here in terms of the flatter yield curve. There's a sentiment, flatter yield curve, don't own the banks. Well, banks outperformed with the flatter yield curve in the 1950s, the 1990s, last year. So certainly a steeper yield curve resolves some of the trade issues. But I think the rubber meets the road with regard to the capital return story at the banks. I mean, banks could almost be a utility substitute. You're talking about dividend yields close to 3%. If you adjust the dividend yield for buybacks, the cashback yield is 8%. That's off the charts. That's the highest level in history relative to the 10-year. So if rates stay low, flatter yield curve, that's a nice cashback return at the bank.
All right, so O'Leary, then, what's wrong with the story that Mike Mayo is writing?
So, Mike, let me ask you about that loan book theory. Half the money going into money center banks now is the idea that rates might go up. You love the fact that they've been very good loan books, not a lot of delinquency. Let's call another 25 to 50 bips of cost to those loans. The bottom quartile, the marginal loan, starts to default when that happens. So that theory that you're buying into the cleanest balance sheet in history goes right out the door when rate hikes start to push on the marginal loan out there. That happens at the regional level, where a lot of scrutiny has been done, but it also happens at the big money center banks too. Why would I get excited about a clean book that can only get worse if rates go up? So I don't buy that premise at all.
Well, I think you're summarizing what I would term as the banking paradox. I mean, when there's risk of credit costs going higher, people say sell the banks. And then the arguments ignore the fact that banks are super safe and people want banks to return more capital. So the concern is, well, sell the banks because they're risky, but then sell the banks because they're too safe and have too much capital. That's the banking paradox. You can't sell the banks for both of those reasons. And credit costs, we have them going higher, but still below the long-term average over the next couple of years.
If you don't own any of the banks today, you would be a buyer of all of the ones that you have as outperform?
Absolutely. We stand behind our outperform ratings, and we are buyers of banks before the earnings, after the earnings, over the next 1 and 3 year
Because
period.
I understand why many of the panelists here are long the banks because they own the banks.
Yeah.
And they're not ready to sell the banks. But I don't hear a lot of glowing commentary about the banks. But it's a different story if you're not in the stocks yet.
Well, I think it's, look.
Well, you're saying it's not.
The banks have underperformed for the last few months, and that's coincided with the flatter yield curve. So it's, I think algorithms kick in, there's old perceptions die hard, but you have 28% EPS growth year over year. That's our forecast. If you strip out the tax benefits, it's still double-digit EPS growth. And going back to the earlier comment from Steve Weiss, we get a run, we'll sell. We think that would be a mistake, too.
Particularly with Citi, which you say is your priority stock of the whole group.
We think Citigroup stock, they're buying back their stock after the report their earnings. And last year, they bought back stock at a pretty aggressive pace in the second half of the year. Never before have we seen this level of buybacks and cap return at a stock that's trading close to tangible book value. This is I think this is unprecedented from what I can tell.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.